Alrighty, so we wanted to just give it. It
Sorry.
takes a little while for this many people to get on, so we just were killing a little bit of time. Hope everyone grabbed their cocktail or their beverage of choice to join us this afternoon. This is the third in our series. Kathleen needs some tequila.
I do.
Kathleen recognizes that.
Yeah, she does. I know. I could tell.
Yes.
For the audience, Kathleen and I bonded over the fact that we spilled a beautiful sipper of tequila together.
I owe him big time.
Anyways, this is the third in our series of the virtual happy hours with business owners. The last couple have focused on PPP loans and loan forgiveness and everything before and in between and after. And today we're focusing more on the value of your business and what to do with the business after we're coming out of the nightmare that we've been in. So what's next? What's happened to your business? So we have Melissa Silverman, who you're going to hear from in just a second, and she's the president of our LA chapter meeting, or our chapter. And then Rose Sorensen, who is going to speak with her, and we're going to let them go in just a minute as soon as we do some introductions. So let me share my screen, and we should be good to go. All right. So as I mentioned, what has happened to the value of my business? So I'll let Joe and Melissa say hello and welcome everyone. As I mentioned, this is an Exit Planning Institute chapter event. We've come together, all three Southern California chapters have come together today, or for this series, because normally we like to do a live business owner forum every year, at least one, maybe two or three. And obviously we can't do that this year. So we're coming up with original ideas and different ways to do that. And we plan to continue to do that as this particular series has neared the end. We're going to extend that as well. So Joe?
So within this, Shelley had mentioned that the first ones were about, how do I qualify? How do I apply for this loan? Do I get another shot at it? Then there was a lot of talk about, how do I deal with given? How do I spend? What do I do? If I'm over 2 million, under 2 million, as you all know, we have 3 iterations now of what this law is, beyond the laws that dealt with something similar before. And within that, we probably had 3 to 5 sets of guidance each, where the technical corrections, other ways to look at it, oops, I'm sorry, no, do it this way, here's a form, here's another form. And recently, at the end of last week, we got a new version of this. For the most part, it has made it easier for business owners like myself and you to not have to pay back as much. And in fact, maybe all, especially if you could use it on payroll over the 24 weeks, as long as you keep a certain number of employees. The only difficulty in that law right now is when they're going to calculate our FTEs for Safe Harbor. And there's going to be some finite resolution of that, probably in the next week or two. There's some technical things wrong with it that they're going to have technical changes to. And as you know, the president took a little longer to sign, so it gave us a little bit more uncertainty. The EPI chapters, as Shelley said, are groups of professionals, advisors from all walks, from M&A to accountants and attorneys to bankers to plan giving officers to people that deal with business owners that are concerned with helping with them on the, do I keep grow my business? Do I stabilize it? Do I transfer it to my family, to my team, or to an outside third party? And do I do that all by taking my chips off the table, or some? I'm the president of the San Diego and Orange County chapters, and Melissa Silverman, who's a valuation expert. Melissa, who's a valuation expert and an attorney and a partner at Founders Group, so a value advisor, is the chapter president in LA. Hi, Melissa, what's up?
Hi, everyone. How are you? Hi, Joe. Hi, Shelley. Hi, everybody. Thanks for being on today. We really appreciate it. I think we're going to have a great program here today. Hopefully, we're going to answer some more questions for you.
And thank goodness we have Melissa as one of our presenters. Can I have the next slide?
Yep.
So a little bit about us. Southern California Institute, that partners with Exit Planning Institute to do these, puts on about 250 programs a year. Mostly live, some digital, definitely live for the balance of the year, except for some of our social
We're going
events.
to try to sneak a couple of
We're gonna,
socially distanced
Drinking
social events. Yeah.
where we do education, advice, and resources for advisors. 2/3 of those are for advisors and 1/3 are usually for their clients. Avenue M is a valuation firm that helps successful families implement not only wealth transfer, but it is business owner planning in all forms of valuation. Strazzeri Mancini helps successful families and business owners. We're best known for resolving messes. Yes, we do taxes. Yes, we do business planning. And yes, we do family business counseling, or what you may call family business conflict work. And then Founders Group that helps business owners with what we talk about at the Exit Planning Institute. Do I keep and grow? Do I stabilize? Or do I transfer to the 3 options we talked about? Within that then, for our presenters, I'd like to reintroduce again Melissa Silverman. Melissa, could you give us a little bit about you? Melissa, you're muted. There you go.
I know. Hi, everyone. So as Joe was mentioning, I am I'm president of Avenue M Advisors, a business valuation advisory firm that really focuses on all types of valuations, whether it be transactional, transactional for sales of a business or mergers and acquisitions, or trust and estates, gifting, estate tax issues, tax related, conversions from C to S corp, ESOP transactions, and just ESOP annual valuations, 409A valuations when people put in stock option plans. So it's a lot of different types of valuations. And then I'm a partner in the Founders Group, which is a business transitions and advisory services firm. And I am also, as Joe mentioned, the founder and president of the Greater Los Angeles Exit Planning chapter. I think both of us just had our chapter meetings today. So I know a lot of people were already on one or both of those meetings. So thank you very much for doing that. So I'm very happy to be here and talking about this subject.
Thank you, Melissa. So Rose, tell us a little bit more about yourself.
Sure, thank you. I'm Rose Sorensen. I'm a partner in the Los Angeles office of Snell and Wilmer. We're a national law firm that has presence in over 15 states and Mexico. My practice is mergers and acquisitions. I have a focus because of my general counsel background. I do a lot of outside counsel advisory work for companies working on their operating contracts, doing their compliance and day-to-day operating affairs in addition to the M&A practice. I also focus on, I was a telecom lawyer when I was in-house. I worked for a private cable operator company, so I do a little bit in the telecom area. And the last part of my practice is just my passion, because I always wanted to learn to speak different languages, is I do cross-border M&A work. And I work with companies that are looking to build or expand their business, usually inbound, and they're looking to set up a distributorship arrangement, some kind of joint venture, or a subsidiary structure here in the US. So thank you for having me.
We're very excited to have you. Thank you.
Now, I'm going to say this again. I think Melissa's been hiding Rose from me for a long time. So I'm thrilled to have Rose in the teaching group. Part of the 3-part series we talked about, we did how to best utilize PPP, then we did most recent developments. We probably will do another most recent developments as we get clarity on last Friday's passage, or last Thursday night's passage. We're up to what happened to the value of my business. To get you a little bit of a setup, is it time to keep, gift, shrink, grow, or sell? Many of you business owners are on the call, and many of our advisors approach us with, I'm exhausted. I don't know if I want to go through another cycle. I'll dig out of this one, but after I'm done digging out of this one, should I really keep it? Should I let my daughter take over? Should I gift? Is there a better way to do it? I was considering selling, etc. I have had 3 sales complete during COVID. I've had 2 sales go completely south during COVID, one because of a lender issue and one because of a buyer issue. And I've had many buyers say, I'll dig it out one more time, Joe, but after that, get me out. And I've had, I'm sellers, and I've had buyers look over and say, I think I'm gonna wait because I think I'll get it for less next year. So we're gonna talk about stuff like that from two professionals that are very much in the trenches with exactly that.
And just to mention, I do get a lot of questions about accessing the recordings for these events. The prior to, as well as this one, will all be able, you'll be able to access those through this registration page. The same one where you registered originally. You'll also receive a follow-up thank you email from us on Monday morning. Once the recordings are available and up, and it'll tell you exactly how to access everything that you might want to access. So watch for those as well. As we go through the logistics for today, I'll just mention if you do have questions, we will be monitoring the chat function, and we'll ask those questions as they are appropriate. We'll pause in between Melissa's section and Rose's section for questions and answers as well. So just if you have questions, go ahead and type them in, and we'll get to them as soon as we can. This is meant to be interactive, so please do ask lots of questions. All right, Melissa, I'm gonna let you roll. What has happened to the value of my business?
Thanks, Shelley.
Yep.
Okay, so there's a little bit to talk about from a valuation perspective. So it feels like the world has completely changed in a matter of months. And so we need to identify and look at what do we do? How do we value companies going forward? And even as we look backwards, what do we do with the valuation of companies? So today we're going to try and answer some of these questions. If you guys have questions that are outside of this or even inside of these areas, please let me know. I'm happy to answer any questions that you have. And I want to make sure that if there's any confusion, I want to make sure that we clear it up. So let's go forward. And let's talk about what has happened. What has happened? Am I moving this? Thank you. Okay, so what has happened to private company values? So let's just talk about what has happened in the last 5 months. We've had a global economic and market conditions that went from being very, very good to being very, very bad. Not due to anybody's own doing. No company has done anything. The companies, the market, everything is still doing really well. But we had this global event that has just impacted everyone. And literally overnight, companies have gone from doing really, really well and having very high values to not knowing if they're going to have a business, down the road. So the global and economic and market conditions has really impacted companies and company values. Now, it hasn't impacted everyone. There's a lot of industries and a lot of sectors that are doing very well. It really depends on what industry you're in. So as we're showing you here, some of the sectors like IT support, we're using Zoom. We've been using Zoom for a long time, but most companies have not used a technology like Zoom until very recently. Let's look at what's happening with consumer products. I mean, for how long you couldn't find toilet paper on the shelves, hand sanitizers, can't find it. I mean, these companies are doing really, really well, and they can't keep their products on the shelves. So some of the industries are doing really well. And then other industries like restaurants, we all know what's happened with restaurants. I was talking to one of my clients yesterday who said he just opened back up last week, and he has no idea what's going to be and how they're going to make it through this, because they're running right now at 25%, but for the last the last 3 months, they have been completely shut down. So it's very, very dependent on what industry you're in as to how your business is going to fare and what kind of values we're going to see for them. You know, it's interesting with cruise ships. While they have not been doing very well, I'm hearing that people are booking cruises left and right now. So I think that that's an industry that has to be watched. But salons, hair, nail, gyms, who knows what's going to be with this? These are companies that may open up slightly, and we may find that we have to shut them back down. We don't know what's going to be. So there's a ton of uncertainty out there as far as what is going to be the liquidity with some of these companies in different sectors. And so it's really on a case by case and industry by industry basis that we have to look at how do we value and what are the values of these companies. It also has a lot to do with the purpose and the use of the valuation. The purpose, whether the purpose is I'm looking to sell my business, or I'm looking to give some shares of my business to family members or to a charities, all the different purposes that we might have for doing a valuation are going to drive whether we're looking for a high value, a low value, or somewhere in the middle. So that has a lot to do with it as well. And the use of the valuation, why it's going to be used or how it's going to be used, impacts it as well. So we have to always look at that and see what are the reasons that we're doing the valuation. That's going to drive it. It also really depends on how long this pandemic lasts. I know nobody wants to talk about that, but you know, if this is something that lasts 3, 4, 5 months, that's one thing. But if this lasts into, you know, the next year or longer, this is going to have a very long-term effect on businesses and the values of these companies for a long time to come. And so, you know, nobody has a crystal ball. Nobody knows what's going to happen, but we just don't know what's going to be with values into the future. But yet we're being asked to look at projections and come up with a value for the business as of the current date. That's what our job is, and it's a difficult one right now, I will tell you that. We also have to look at how much value has been eroded and how long is it going to take to get back to the baseline. Now understand that December of last year is probably the baseline for most, it is the baseline for companies. So how long does it take for a company to get back to where they were at as of December last year? And again, for some companies probably are doing better than that. Some companies, it may take, you know, a few months and they may be able to get back. And other companies, it's going to take a much longer time. And we just don't know. So that's what we're dealing with when we're looking at valuation. We have to do analysis around all of this and try and figure out how do we put a value on a company in today's environment. So let's go to the next slide. And we're going to talk about how do we value a company, and we're talking mostly about privately held companies. So how do we value a company in today's environment? And I hope you guys like the coffee cup. I actually really like it. My EBITDA, which is EBITDA, earnings before interest, taxes, depreciation, amortization, and now coronavirus. We have to make sure we understand that because that's really the environment that we're in. So in today's world, we're going to talk about the market comparison. There's different approaches to value that we use to value businesses. We're going to come back to the market comparison approach in just a moment. I want to first start with the income approach. Under the income approach, we typically will use a discounted cash flow method or a cash flow analysis. And in this method, what we're doing is we're looking at the projected earnings of a company, and we're going to apply a discount rate, and we're going to also bring it out or extend it out to what we call infinity, or we're going to determine what a terminal value is. And then we're going to bring it back and we're going to determine what's the present value of the business based upon those projected earnings. Discounted cash flow analysis get used all the time. And typically we look at 3 to 5 years of projections for a company. The question that we have right now is, how realistic are projections? Are companies even able to project out. Typically, when a company provides a set of projections for this analysis, they take their historical financials, their P&L and their balance sheet, and they're going to just project out a series of, I'm expecting to have 3% growth rate or 5%, whatever that growth rate is, and they're going to develop a set of projections around that. That can't be done right now because we don't know how realistic that is, and chances are you can't look at your historical financials and project out, because right now we have to figure out, how do we get you back to your historical financials? How do we get you back to your baseline? So right now we're looking for companies to really create a set of projections that really are going to help you to get back to your baseline. How long do you think it's going to take to get back to that baseline? Do you think it's going to take the next few months? Do you think it's going to take a year? Do you think it's going to take a couple years to get back there? That's what companies have to do. And this is very, very difficult for business owners to do, because no one has a crystal ball. No one knows what is going to happen in the future. So we're asking people to have a crystal ball and project out when we really don't know. So it's very, very difficult to do. The other thing that we have to look at is, what is the current burn rates that companies are going through? And we have to compare that to what their previous burn rates were. So how much cash does the company have, and how fast are they burning through it? We need to understand that. That's something else that in these projections we have to really take into consideration. So, but the discounted cash flow analysis is a very good method right now to value a company. So, so this is one of those approaches that really is being utilized to value businesses today. Another approach that is not typically used to value companies, but right now is being used to value companies, is this asset value approach. The asset value approach really takes your balance sheet, and it's going to adjust your assets and your liabilities and your equity. It's going to take it from book value and adjust it to market value. Now, I mentioned it doesn't get used that much, but right now, when we're going through this kind of environment, it actually is a good method to use to value companies. Now, the question I get asked all the time is, well, what about discounts? You know, is there any additional discount that we can take because we're in this COVID-19 environment? Well, I'm going to tell you right now, there is no COVID-19 discount, but there are additional discounts that can be taken because the market, the economic and market factors dictate that there is additional discounts. There are government restrictions on all companies today. That requires discounts. So there are discounts that can be taken, but they're not specifically for COVID-19. So if we go to the next slide.
Well, Melissa, can I ask a question? If we go back, you said that these are discounts to be taken, but they're not COVID discounts, but it seems temporary in nature. How much does it affect the value of a permanent business when we've got these temporary things? How do you work that out?
So it is temporary, but again, Joe, we don't know what temporary means. In the valuation world, there is talk that this is going to impact companies for at least the next 12 to 24 months. So
there's also discounting because of uncertainty about the temporary. Is that fair or unfair?
That is very fair, and that gets applied in both the discounted cash flow analysis. For the discounted cash flow analysis, one of the things that we do is we look at the uncertainty of the projections. And right now, there is severe uncertainty in projections because nobody knows how long it's going to take nobody knows if they're going to meet their projections or how long it will take to get back to a baseline. So
thank you.
So there's uncertainty there's discounts that we take in the discounted cash flow analysis, but there's also discounts that we take in a discount analysis when we determine what the shareholder or partnership interests are worth in the company. So now if we go back to the next slide, now let's come back to the market comps. And let's talk about how do we use market comps right now? Because market comparisons are we look at public company market comparisons, and we use that as a proxy to value privately held companies. Now, we know that public companies and privately held companies are very different, and there are adjustments that get made to reconcile that. We also have private company comparisons that we use, which are also key indicators of value for privately held companies. The problem that we have is that if we look at historical comparisons of companies that have sold, we're looking at companies really in 2019 and going backwards, we're looking at a time where things were really, really good. And the markets were up, values were very good, businesses were selling for a lot, and so we end up overvaluing the company. So what do we do in that instance? So this is a situation right now where the market comparison approach is not the best option to use to value a company because of the fact that the multiples are going to be too high and the values are going to be too high from this approach. However, having said that, we still need to look at this approach and we still need to use it as a sanity check to look at, does it make sense what the overall value of the business is that we're coming up with. So I hope that makes sense to everybody. Let's go to the next slide. And one of the things that we often have to deal with is we typically do valuations as of the previous year. There's a lot of reasons why a business owner may have to have a valuation done as of the end of 2019 or sometime in 2019. So what do we do with that? How does that impact? Because we now know that we're in an environment with this pandemic, and we now know that values are much lower than what they were in 2019 and before. So how do we address that? Well, to be quite frank about it, it's up to the valuation advisor to determine if they want to include a subsequent event clause in the report and explain what has happened post the valuation date. But we are not allowed to let it impact the value of the business in 2019. So I know that this does not sound right, but if you have a valuation done as of December 31st or any time before that in 2019, you're going to see that the value is going to be much higher than what it would be right now. And one industry where this gets, this is a very typical thing, is with ESOP companies. ESOP companies are required to have valuations done on an annual basis. And it's typically done at the end of the year or at the end of their fiscal year. So we're doing valuations of companies right now as of December 31st, 2019. And while we are including this subsequent event clause in there because we believe it does impact the business owner and their business, we cannot let it affect the value. So we can explain the hypothetical situations and we can address it, but we cannot let it affect the conclusion of value. So what that means is we have to be prepared to justify the conclusions of value that we come up with as of these time periods. Now, what we're suggesting to our clients and what everyone in the valuation industry is suggesting to clients is if you are able to move your date, instead of having it be at the end of 2019 or some time in that period, if you can move it into 2020, into the time where we have been impacted by this pandemic, then it may be in your best interest to do that because we're able to now get these lower values for the companies. You may want the lower value or you may not. So you have to look at what's the purpose and what's the use of the valuation, and that's going to dictate what you're doing. So now if we go to the next slide, I want to just talk for a moment about the CARES Act and what's the effect of valuations on the CARES Act. So valuation is all about liquidity. And one of the things that we really have to analyze today is what's the liquidity and what's the potential liquidity of the company. So there is a lot of additional analysis that have to be done on every valuation. We have to run scenario analyses now to figure out, is this company going to be around in 3 months? What about 6 months? What about 12 months? What's the likelihood that they're going to make it? And there's a lot of companies out there that may not make it, and we have to really analyze the liquidity of those companies. So, you know, one, we have to take a look at how much debt, how much leverage does each of these companies have? And have they taken any of the PPP, the EIDL, or any other monies from the CARES Act? Do they have the potential of having that loan forgiven? Now, hopefully, a lot of companies will have that ability. But if not, can they repay their loans? And if they have other loans, because a lot of companies were leveraged before this happened. So what are those companies doing? What's their ability to repay these loans? What are the options for them? And we have to look at, can companies get other financing right now? So there's a lot of analysis that we have to look at to determine, you know, how liquid are these companies, and what effect does that have on the value of their companies. And lastly, I just want to mention, there are a lot of benefits that business owners can get right now from lower values. So don't think of this, you know, there's a lot of good things right now. If we go to the next slide. First of all, there's a lot of companies out there that are looking at asset protection. Shelly, can you move us, or Taz, can you move us to the next slide? And 2020 is a great time to move assets out of your estate or out of your business in order to lower your value because of the lower values, and to minimize your taxes. We also have an election coming up, and there's a lot of talk that the value of the business, or not the value of the business, that after this election, no matter who gets into office, that they're going to lower the exemption amount. And so there's a lot of business owners that are taking advantage of being able to move assets out of your estate, whether it be through gifting, through making charitable donations, selling to a charitable private placement life insurance fund. There's lots of different ways to take advantage of this. So that's one thing. Another thing is, if you have stock incentive programs in place, you know, the whole idea here is to be able to make it affordable for your employees to one day buy the shares of stock. And so they're always looking for a low value when they get these 409A valuations done. This is a really good time for granting stock options because the values are much lower. We're seeing enterprise values that are at least 15 to 20% lower than what they were previously. For some industries, it's even more than that. And other industries, the values are actually up because they're doing so well. So it really depends on what the circumstances of that business are. And then the last thing is, you know, there are still acquisitions of companies that are taking place. Some of the companies are selling for a discount and some of them are not. It's a good time from a mergers and acquisition perspective. If you're sitting with money and you are looking for some good businesses out there, they are out there. You have to just look for them. But again, it's going to come down to what a willing buyer and what a willing seller agree upon. And that's going to dictate what the market value is for that business. So I think that's all I've got.
So Melissa, can you share a little bit about the discrepancy that we have right now with the fact that there are tons of incentives to look for lower valuations, right? Like as you explained in the stock option context and gifting. But we also have the challenge that you want the complete opposite in terms if you're looking to do an exit or a sale. And how can we help bridge that gap, or what are some of the valuation considerations that can help you get to that next level? I know timing was some of what you were discussing.
Yeah, timing is everything. So, you know, I'm talking with business owners, and there are businesses out there that are doing well and their values are holding up. As a matter of fact, some of them, the values are skyrocketing. The multiples are skyrocketing in some of these industries, not all. And so it's really on an industry by industry basis, and it's on a company by company basis. What is happening, and Rose, I think you're going to be talking to this, but there are opportunities for there to be control premiums and warrants. There are ways of making it a more valuable transaction for the business owners by structuring it certain ways. If there is a control premium that is warranted and can be justified, then there's no reason not to take a control premium. So and sometimes it's in everyone's best interest to include warrants as a way for the business owners to get future equity in the business if it's not appropriate for right now. So I think that there are ways to do it and to structure it. But again, you have to look at what the timing is, and that timing is going to dictate, what kind of value we're going to see. And maybe I'd love to hear what your thoughts are around that.
I think you're right. There's a lot of variables that go into that. And it is, the problem right now is there was a question in the chat about, is there some way to adjust for this COVID situation? Can you look back at other companies or other time periods and things? And I think the bottom line answer with that is COVID has such a different and disparate impact on every company, even within the same industry right now, that it's very difficult to make an adjustment for that. So you have to be able to take a longer term horizon to try to figure out what makes the most sense. And part of your decision in terms of whether you're going to shrink, grow, keep, or sell has to take into account how much risk are you willing to take right now with the fact that everybody has a different perspective on that COVID valuation factor, right? Some people look at it as an aggressive way to get an additional discount and perhaps a bargain in an otherwise distraught industry or segment of the economy, while others see it as an opportunity because there is this robust industry that has picked up and is actually flourishing because of the COVID scenario. So there is no one size fits all approach right now.
Yeah, I completely agree. Okay, so
Very cool. So thank you, Melissa, very, very much. And I know you're going to hang out with us. Rose, it looks like you're almost up.
Oops.
Sounds good.
So Rose is going to help us with, what do I do now? What should I be doing?
With all those factors or not, I own the business. I've been thinking about all these things. I'm a little confused. I was going to sell. I was going to give. They were going to take over. I think I might have to jump back in. God, Rose, I'm tired. What am I supposed to do?
Well, we're going to explore the legal side of things for you to give you just an overview of what's out there. So we're going to start with just taking a quick little review of the deal flow, what's been happening before, during, and what's projected for after COVID. We'll look at the deal structuring. What does COVID mean? And looking beyond COVID, because there has to be some, despite the fact that we are in COVID now, there has to be some go forward path for business. We're going to take a look at what that means in terms of due diligence considerations. So whether you're prepping for a sale, you're looking to do a sale, or you're trying to postpone a sale, you ought to be cognizant of some of the changes that have come about because of our current circumstances. That also change brings about lots of opportunities. And some of these opportunities are internal restructuring opportunities that can help you reposition yourself. So look, not everything is negative. COVID is challenging, but there's silver linings, right? I can tell you I've gotten to spend a lot extra time with my family that I wouldn't have had otherwise. So in some sense, I'm grateful for that. I know it's challenging on other ends, but there's always that dual role on everything. The next thing we'll take a quick look at is, there is a potential downside, but it's not instantaneous. So we'll take a look at some of the factors that may be leading to that anyways. And then we'll go back and take a look at how do you take advantage of the uncertainty? What do you do? Nobody has the crystal ball, as Melissa suggested, and no one's going to get it. So we've got to figure out what we can do to go forward. And lastly, we'll try to answer that question of, is it time to keep, gift, shrink, grow, or sell? So let's start with the first slide. The deal flow situation before the COVID situation was a seller's market, as we all know. Deals were moving forward. There were good deals, were in short supply, so multiples were high. There was the consequence of the extended growth period in the bull market that essentially left very few desirable targets. There was still a lot of money out there. That money hasn't changed. What's changed is that the COVID impact essentially put buyers in control a little bit more, so it shifted the market temporarily. So buyers were now becoming more hesitant and wanted to factor in this COVID factor, but unfortunately no one can really tell what it meant. So what started to happen is on some of the sell side engagements, companies that were in the process of selling, as Joe mentioned, some rushed and closed in order to avoid the real fallout of what COVID might be. Others, they started to do the sales side process and then had to pull back because the markets weren't going, people weren't meeting, there was no real way to get a true test of the market. And for some of those that were in the uncertain environment where they had supply chain issues or were affected by effects in other countries that might affect their business, they had to kind of pull back and say, okay, let's wait and see, because some of these buyers were coming back and saying, COVID adjustment, purchase price change, or earnout, deferral, all of these terms that sellers don't want to hear, especially not as you've already started the negotiation process. Buy-side engagements were a little bit of a mixed bag, and again, it just truly depended on what part of the industry you're in and how you're affected. Now, after COVID, what is our deal flow going to look like? I wish I had the crystal ball to tell you. So we don't really know, except that we know that buyers and sellers are reassessing the path forward because business has to get done, right? And there are businesses that are still doing business. So even though there are many affected, it's not the entire universe of where we're at. So there are still some opportunities in industries that may surprise us. Things like, for example, janitorial services, right? These companies, even though we've had shutdowns, you would think that their businesses would have gone down because office buildings were empty, yet they are part of the reopening and the go forward process because of all the OSHA requirements that require you to have the cleaning processes and things, the extra hand sanitizers, the wipe downs, the public common area issues. So there are some businesses that are actually popping up and are surprising us from that impact. And as Melissa said, there are going to be some winners and losers, right? There are some industries that are just faring so well that probably the adjustment will be a mini blip that brings them back to a standard valuation performance metric. And for others, it will be the opposite way around. There will probably be a big jump because these companies were doing well before COVID. So other than the fact that COVID is an unprecedented situation and business came to a grinding halt, financially and economically, there was nothing wrong with the model that these businesses are following.
Rose, Rose, it's Joe, if I could, can you talk about what lenders have been acting like through this?
Yes, lenders have been very interesting right now because they have been overwhelmed by the government funding programs that are out there. The first one that we all know about is the PPP program. They have been inundated with requests for processing that. First, it was the applications, now it's the loan forgiveness process. On top of that, they're busy trying to figure out what their role is in all of this. Some lenders were concerned because of the liability of trying to figure out whether they have to assess credibility and eligibility under the loan terms or whether that's an SBA determination. So they've been kind of taking a hands-off approach. The next program they've got coming out is a Main Street lending program that's going to launch supposedly any day, but lenders really don't have the bandwidth to focus on that right now. And it's so much more complicated because that requires a restructuring of your debt, and it's a partnering with the government who's going to share in collateral. So it makes it a much bigger animal. So what I'm hearing from a lot of the lenders today, I can tell you, I've heard this from some bankers at Wells Fargo and B of A, is that they are shutting down the pipeline. So they are not in a position to readily lend funds. Instead, what they're looking to do is try to help their existing client base reassess their lending needs. And as parties are coming in, there's parties asking for deferrals, there's parties asking for waivers, there's parties asking for restructurings. They are taking the time to revisit because their biggest concern of what they're experiencing with companies is that companies have not been taking the proper long-term focus from their perspective. So because we've had the PPP program, for example, many businesses thought that this 8-week period was going to be their be-all, end-all solution to get them to the other end. The problem is we are not going back to business as usual in all industries, right? So there's that bridge, that adjustment period that we need to account for that PPP as originally drafted didn't address. Now that it's extended for a 24-month period, it's actually much more helpful, but you've got the challenge that some businesses were so worried about what was going to happen that they actually started to spend down their money before they were in full operations and couldn't get the benefit of that program 100%. So lenders are definitely posing a little bit of a challenge because they've tightened up the markets.
Cool, thank you. Next, Shelley, please.
if we can move to the next slide, please. So deal structuring. What's different in terms of deal structuring? Well, interesting, timing is different. You would think that given the craziness and what things are going on, that most people would be rushing to get these deals closed and moving. And in fact, they're not. And buyers in particular are taking an extra amount of time delaying these transactions because they want to see if they can price in the effects of COVID. So they want to come in and do their risk assessment, which is also being affected right now, right? Instead of doing the traditional M&A and things, they're focusing on things and scrutinizing the due diligence from a very different perspective that gives them the ability to adjust what the financial picture will look like on the transaction. The financial matters portion of it is they're coming back and restructuring in terms of purchase price. They're using much more earnouts. They're using a lot more deferral compensation arrangements, and they're putting a lot more in terms of performance-based covenants to justify what some of that purchase price means. Now, there are some groups that are taking a more of a partnership approach, and they're looking at it and saying, look, we know that there's a period of uncertainty, so we're going to figure out how to position ourselves to be in the best position to capitalize whatever happens next. But we don't want to commit 100% either because we don't know that anything's certain. So they're looking at opportunities to come in, and instead of doing what they would normally do as a full majority change of control, they're looking at minority investments where they're coming in and saying, look, we'll fund you, we'll give you a little bit of capital to help you through this, we'll give you a little bit of strategic advice and help you see what it is that you need to do to survive to the other end. And then once we get to the other side, we can reevaluate and see what kind of transaction we might partner and do. They might do it together. They might bring in another party. There's a lot more flexibility in that fashion. But if they believe that you've got a business that's got some viability and potential that they're interested in, they're willing to take a chance on you. And what that offers you, that minority investment, is a strategic partnership of building with some of these players who will be able to share their expertise to try to get you to the other side. Something else that we've been seeing a little bit is that it's, in some of these cases, out of the concern for what's going on, buyers are doing all equity deals. So there's not a lot of cash trading hands because you can't value exactly what's going to happen. So more and more all equity deals are happening. Now, some players are actually being more creative than that, and they're coming up with debt plays. So they know that many companies have PPP loans and I always forget the emergency disaster loans that have come into play. So they're trying to come in and position themselves behind those loans, which obviously have priority, and yet above the common level. So they're trying to come in as debt that will have an opportunity to help bridge your activities through whatever you need to get through in whatever this COVID situation represents for you, and still positioning themselves so that as things turn around for you, they are first in line to be able to work with you, and hopefully you'll appreciate that partnership to consider a potential sale or a majority transaction at a later date. So right now, what you should take a look at is that those partnerships present opportunities from both sides, both for the buyers and for the sellers. That being said, in the transaction context, the due diligence considerations have changed and things have shifted in terms of what it is that we are looking at. So financial considerations, for example, exactly what Melissa just covered, valuations, big ticket item right now. How do you value all the issues she raised? What's the impact on the future financial performance? Those projections that Melissa is talking about have become invaluable because you need to be able to adjust for what the short term looks like in addition to projecting the long term. And it's okay to factor in there that you'll be back to normal at some point, but you've got to show that you're taking it into the account the uncertainty in order to show that you've got financial accountability and that you're aware of what's going on. It shows a level of sophistication that really positions you better. The other thing is customers. To what extent is customer behavior being altered forever, right? What's the direct-to-consumer changes that you might have seen? What are the different online platforms versus the brick and mortar that have been changing? Are those temporary? Are those permanent? Are there industries in which it's worked because of the situation we're in, but customers are going to demand a certain level of personal attention to go back, and there has to be some kind of additional hybrid adjustment? So for example, take a look at the beauty industry. Is everyone going to be okay ordering that the cologne or the lipstick shade or whatever online without being able to look, touch, see, and feel? Who knows? People are doing it right now, but we'll see what happens. Some of those are the uncertainties. Suppliers and supply chain, big issue. We've all heard about it time and time again. What does it look like, and how quickly can you shift it? Can you diversify it? For some businesses, there's tooling involved. There's molds and things that are being held by offshore supply chain providers, and it's very difficult to move those and very costly to replace them. So sometimes partners are stuck in that supply chain relationship because of those cost factors. Employees and operations. What's your workforce look like? Have you been able to restart your operations and come back full time? If so, are you having issues bringing some of your employees back? Some businesses we've seen, particularly in the restaurant area, are having a huge problem with that because many of their employees are making more with this $600 federal unemployment stipend than they do otherwise. So they'd rather wait it out. Now that's supposed to expire at the end of July. So you would think that an offer today versus an extra month or so of the extra money might have more value, but you'd be surprised the number of businesses that are experiencing this issue, and the uncertainty as to whether or not that will be extended is also adding to the complications. From the operations perspective, can the company perform on its contractual obligations? We've heard a lot as things came out about force majeure clauses and things like that, and yes, those have come into play, but they've been broader and vaguer. The more challenging issue at hand is, what has been your communication with your companies and your clients and customers, and how well have you been able to manage that so that you can create the room to continue to operate? That's financial buyers are going to be looking at that kind of positioning and what your relationship is from that perspective. Another very hot key area is the information technology and cybersecurity area. Do you have sufficient IT capabilities to ensure productivity, to ensure that you're providing network access to your employees working from home or remotely? And do you have the wherewithal to be able to put in the intellectual property protections so that, one, you can guard the information, whether it's yours or that of your customers, and two, you can protect against cyber risk? One of the biggest challenges for companies right now is that cyber risk, because these cyber criminals are taking advantage of the most basic attack on companies, which is the phishing scams. Those emails that said, hey, you got 2 free nights at Marriott, click on this and give us your information. We see those right now all the time. We've got companies that have been coming to us. There's groups like the Maze Group that are actually taking the ransomware attack to a different level. And not only do they extort companies for money, but they are now publishing that private information on the dark web so that it's available to everyone, trying to put additional pressure on businesses to respond. So how well you're positioned to address that IT component is a big cost factor, because the compliance of trying to make sure that you respond to a cybersecurity breach can be very expensive depending on the type of information that's breached and in what states your customers or employee information resides.
Rose, can I just jump in for 1 second?
Absolutely.
I just want to add to that. That's a big issue that we address in valuations as well. There's a whole risk assessment around risk management, cybersecurity, all of that, and what companies are doing now to protect their businesses. That's something that now is taken into consideration in valuations as well. And that does have an impact on the values of companies. So Rose, I completely agree with what you're saying there about that.
Yes, we keep hearing more and more about that as an issue. And related to that is the COVID response. And what this means is really the practical operational response that businesses are having to implement in order to satisfy OSHA requirements and different mandates that have been put out by the various government agencies that say, if you're in the restaurant industry, these are the safeguards you need to have. If you're in the manufacturing industry, this is the safeguards you have to have. Retail, there are requirements that you need to have an emergency preparedness plan in place that addresses what you're going to do in response to a COVID situation in your environment. What are you doing in terms of people, and how are you bringing them back? If they're sick, do they know that they shouldn't be coming into the office? Are you masking? Are you taking temperatures? What's your policy in terms of responding to all that? And is it communicated to your employees, which is the key? So that too is a big issue, because businesses are not used to having to deal with all this extra regulatory requirements in order to just operate on a day-to-day business. Many of them are already tapped for resources, and now having to do this as well has been more challenging. Next, they're also looking at liability and insurance. Does the target's company insurance policy cover losses related to COVID? I think in most cases we've seen that the answer to that has been a flat no. There's been some companies that have come back, and to try to make adjustments for that, they've offered some kind of discount on the policy rating, policy premiums and things, but there's been no full coverage. That was compounded upon now by the riots, and there was thinking that, thank goodness, so we weren't eligible for COVID coverage, but the riots certainly are. And what many businesses are finding, at least initially, is that, you know, the riots were brought about partially because of COVID. So insurance companies are drawing a connection to try to exclude that from coverage as well, posing more challenges for business owners, in some cases whose businesses have just been decimated by some of the looting and the random attacks that they've suffered. So that too is another aspect to look at. And take a look at your insurance policies, because cybersecurity insurance is something that not many businesses have, but you may want to consider getting that. If you wait until you've had an attack, it's essentially worthless. There's no point to consider it at that point. Lastly, liquidity. Is your company likely to be cash flow positive? And does it have enough liquidity to support itself on a post-COVID basis? Or will and a post-closing basis, or will the financing party have to come in and bring in access to additional financing? It's a big consideration right now because lenders have shut down that lending pool. So they're being very cautious about what they're going to put out there. And private equity groups and some of the other institutional buyers are finding some constraints. That's not to say that that's all of them, because many of these groups were sitting on piles of cash, because since the market was so robust to begin with, they were having a hard time finding good quality deals. I think what good quality deals are is being reassessed, and is probably going to open up those pools a little bit more. But these are all factors that go into what your valuation will look like, how attractive you are, and what's going to come out on the other side. And all of this plays out in terms of how you allocate risk in these new deals. And oftentimes you could do it through a purchase price negotiation. Not the best way for a seller, right? Because you're usually coming out on the losing end. There's a push towards more earnouts and deferrals. There's greater push on more representations and warranties, and we're seeing parties requiring sellers to make representations and warranties about the COVID effect on their business. Think about it. Do you really know what that effect is, or how you can provide for it? It's a very tricky rep, because it can shift a lot of risk allocation onto one party, and yet we don't have the basis or the information to underlie that analysis and be able to make it on an informed basis. Lastly, there's closing conditions that are being affected, termination fees, and special indemnification provisions that are actually calling out for COVID situations. So there's a lot there that you need to take into account when you're going into the deal scenario and considering whether or not you're going to be selling or even buying another company. But all of this isn't bad news. Let's move on to the next slide, and we'll take a look at some opportunities. There are some internal restructuring opportunities that are coming out of all this, right? So the first of these is financial restructuring, and we've already seen that with the government subsidies that have come out in the form of the PPP loan program, the Main Street Lending Program, the EIDL program, and some of the other subsidies that are out there. There are lots of opportunities to take that money in, and it's your opportunity to figure out what you need to do with that. Some businesses are getting stuck in the rut of thinking that they need to go back to what business was, what is it now, 3 months ago, before we started the COVID situation in full force. But that may not be the case. This is your opportunity to do a SWOT analysis that will give you the possibility and opportunity to reposition your business for a potential turnaround, right? Or even growth, which is the benefit of this. So you need to go through and take a look at what operational restructuring opportunities do you have. The largest expense on the books of many companies is usually real estate and employee costs. It's a great time to take a look at, do you really need all that real estate with the remote workforce concept? How is that working for you? What's your business model looking like in terms of direct-to-consumer access? What about headcount? Can you reduce headcount? Is there a way that you can benefit from technology to help make that happen? What is the response that you're getting from your workforce? Is everybody willing to come back to work, or is the concern of a resurgence of COVID cases posing problems for you that you might need to address head on, which will also have an economic impact on what you do? having to hire new employees and train new employees is often more costly than trying to be able to bring some back. So you need to take a look at that. You should revisit your supply chain and see if you've got the opportunity for diversification. What's the timing on your ability to do that? Can you shift, or are you one of those parties that's got the molds locked up in China and you can't do anything without a process and probably a cost factor and a negotiation? You should take a look at re-engineering your delivery methods. Is there a way that you could get some cost savings from that? You may not need to go back to the old way of doing things. There's a lot of opportunity, and you just have to be able to take a look at it from a different perspective. You've got to have the ability to pivot so that you can truly maximize your positioning to get out of this situation on a positive footing. And many businesses are actually finding that they're identifying opportunities for growth that they could bring on an add-on business that might help them get to the next level or surpass this time period by bolstering with some kind of additional outreach or expansion of their business that perhaps was in the back of their minds, but they didn't have the opportunity to explore. And the last thing that you need to do in terms of internal restructuring opportunities is remember, communication is key. And particularly in times where there are problems, you need to take advantage of that strongest tool. Develop the message for how you want to position yourself after you consider both your financial and operational restructuring options, and then talk to your constituents. And remember, your constituents are your employees, your suppliers, your banks, your landlords, your customers, anyone that you touch on, either because they bring business to you or you bring business to them. And the better that you can position your message ahead of time, the better and stronger position you will be in to control that message. So you need to do an internal assessment. Just like before you're going to prepare for any sale, my thing is you always need to know your own skeletons in the closet, because if someone brings those out first, you're at a disadvantage. And that usually means price and valuation. So keep that in mind. And your ability to pivot in the situation will be key for how you turn out on the other side. If we can turn to the next slide. Now, there's always a potential downside. And let me tell you, I'm an optimist. So if you can see at the bottom of my slide, one man's trash can be another man's treasure, right? So some company not doing so well, having had liquidity problems going into the COVID situation already, may be very challenged. But you know, there may be another business that could see an opportunity with that, and the depressed values might just be able to put them in a position to expand or grow their business from that perspective. There are a lot of things to consider in that. And if you're facing the downside, don't worry, there's ways to exit gracefully. They're not all difficult, or I should say they're not all as difficult. They're not all court supervised, and there are options. And it's a very complicated discussion. So I'm just going to touch on a couple of things that you should keep in mind, but this really requires a more in-depth consideration of the matter. But some of the options that you could have in terms of non-bankruptcy alternatives is recapitalize your company, right? Could you do a rights offering? Is there some way that you could tap into your existing shareholder pool or do some type of exchange to recapitalize that might give you a little bit of breathing room to survive? If not, consider you may have to do asset sales. Asset sales are not the cleanest, right? Because you have to try to extricate the assets, and oftentimes they have many hands on them from lenders and other parties that are secured by the collateral. But if you can extricate the assets, free them up, and put them out there to market, there are opportunities for you to be able to do some kind of more graceful exit. And sometimes your assets are worth more than your company as a whole, depending on what those are. So you have to be open to the considerations and don't keep blinders on, because you need to look at it from the potential of maximizing your value, even in a down situation. Take a look at debt restructurings. I can tell you I have spoken to many lenders, and from the debt restructuring perspective, the one thing they're so surprised about is that borrowers' expectations and the reality of what lenders are seeing are not matching up. So they're having borrowers come in and say, hey, can you waive my payment for 60 days or 90 days to help me get through this COVID situation? And many lenders are coming back and saying, we need to reassess this. 60 to 90 days is not going to get you anywhere. You're only postponing the inevitable. Let's take a look and see if there's some restructuring we can do. Take a look at what you did with your line of credit. Many people panicked and drew down on their lines of credit, so they've got cash somewhere that they can use and factor into the equation. All of those pieces need to be taken care of so that you are not surprising them with your ask or outreach from a debt restructuring perspective. But you should definitely, again, Keep the lines of communication open with your lenders. The more you keep them informed of the process, the more they'll be willing to work with you, because they don't want to be surprised either. And they know that they've got a basket full of eggs, and who knows what those will look like at the end of the day. To the extent they can protect some of those from cracking or having problems before that, they're more than willing to try to consider that. And right now that there's a lot of interest with the government subsidies and things and trying to help some of those companies that couldn't get in line, banks are coming back and saying, look, you didn't get PPP initially, but you qualified, go ahead and resubmit, because a lot of the pullback of those funds that went to some of the Shake Shacks and the Heartbirds and the Lakers and parties that truly were not the target audience for these programs is now back in the pool. So I understand, at least as of last week, that lenders were saying that they're planning that they're going to be able to take applications through the end of June, which was not the case before. Another alternative that exists is an assignment for the benefit of creditors, which is essentially a contractual agreement to liquidate your business and sell assets without going through a judicial process. It's a streamlined way of doing it. It's less expensive than bankruptcy and gives you a little bit more flexibility. But again, you're dealing with a bunch of different creditors and interested constituents. So it's a challenge from that approval process. And then of course you've got your bankruptcy processes, like your Section 363 sales, your secured creditor sales that are kind of like a public-private foreclosure sale that you can do under the UCC, and the judicial receivership, which is an actual judicially overseen procedure. There's lots of opportunities out there. There's limited due diligence and fewer contractual protections in some of these than in a bankruptcy context, but there are great opportunities, and you should look at it not only from the perspective of, I may be needing to avail myself of these things, but do you have a stretch? Do you have any cushion that might put you in a position to partner or take on some of these assets to grow your business or pivot yourself into a new way to pull yourself out of this COVID situation? If we could turn to slide number 6, please. So this is the last piece of the puzzle, and this is a little bit broader, and I think Joe will jump in and help with this as well. But, you know, take advantage of the uncertainty. Be creative. Consult your advisors. You are meeting people. I'm sure many of you, I know webinars have sprung up left and right in this day and age. Take advantage of the fact that you're meeting advisors that are willing to give you some free time to chat, discuss, and cover issues. Mind you, it will not be personalized advice, but you could use it to inform yourself about different areas that you are not familiar about. One of these that presents opportunities is in the gifting and estate planning context. Can you hear me?
I can hear you, but we lost your screen. Or I'm sorry. Yes, Rose, we can hear you, but I lost your picture.
Sorry about that. I see myself frozen on the screen, so
Okay. Well, we can still hear you, and I'll jump in for a minute. I will share, Rose, we did talk about this before. Melissa, this connects to Melissa well. If we have a family that has business in a generation, and they're going to eventually move it to another generation, but they want to keep control or they don't, because of the uncertainty discounts that Melissa's been talking about that are real, it is possible to move a business to another generation. We're not going to do it for a family that has less than, with a married couple, let's say assets below $15 million. Because yes, we're at a $26 million exclusion, and yes, in 2026, it's going to go down to roughly $13 million. So if it's less than $15 million family, no. But if you have a family who's got assets $20+ million, and the business is a big part of it, and the family members are included, and they're looking at shifting it, now is a fabulous time to be looking at that, especially if you think we've got uncertainty, we're going to drive that value down, we're going to move part of it, take some lack of marketability, minority discount, not COVID discounts, but COVID-related uncertainty discounts, etc. And I'm going to be able to move that, solve for an estate tax, etc. I'm great. The other thing against that, though, is if I'm moving stock, if one person dies, I could have had a step up in basis. So there are these competing factors inside all of this that are still playing in. But for the advisors, it's a great opportunity to talk with their clients. And for clients, it's a great opportunity to take a longer look at this rather than just the panic of today, the longer look at what to do. Thanks for giving me a shot, Rose.
Perfect, Joe. If we could move on to the last slide. And remember, I'm the lawyer on the call here between me and Melissa. So the big answer to the big question, is it time to keep, gift, shrink, grow, or sell? It depends. So sorry, but it does. COVID is a very personal situation and it impacts your business in different ways. So what you really truly have to do is sit down and realistically analyze your options, but do it from a broad-minded perspective. Don't just look at what you have and whether you're limited to that. Explore, think big. It's an opportunity to restructure and see what you can do to take yourself to the next level. Explore your SWOT. Most people do the strength, weaknesses, opportunities, and threats analysis once when they're starting a business, if they're lucky and they've talked to some business advisor, and they never revisit it. You should revisit it because those change dramatically as your business grows and as circumstances like COVID come about. Thirdly, think outside the box. Not everything has to be a negative situation. You may be able to turn a negative situation into a positive situation through an add-on acquisition that might make your business more profitable. And then, as Joe was just mentioning, consider your long-term horizon. What opportunities does this give you? And don't just think COVID 3 months, 6 months, 9 months. Think COVID 18 months, 24 months, 36 months, and then what would it mean beyond? You need to position yourself because you don't know what's going to happen with that. And lastly, take advantage of one of the best assets that you have, which is consult your professional advisors. And if you don't have any, feel free to approach some of the advisors that you meet at webinars and things. And having met Joe and knowing Melissa, I know that this group in particular is extremely open to having that kind of connection and kind of follow through and follow up with their customer base and their followers, because I saw that happening in the chat box as we were having the presentation. So take advantage and maximize the use of your resources. Not everything is negative and there is opportunity around the corner. It's just how you present it and how you encounter it.
And I agree so much, Rose. I would suggest to business owners who are out there and the advisors that are with us too, now is a great time. I've got clients that have leaned back and said, Joe, fortunes will be made in the next year because people will gain market share and come out of the back end of that and do incredibly well. Joe, I would like to increase my market share so that way when we come out, we do much better. Joe, I'd like to double my business. Joe, I'd like to do. So they're taking an aggressive stance in order to say, and the worst could happen is I survive. I'm very concerned for business owners that are looking at survival, because if their survival is their top notch, then something underneath it is much worse. The other part, as Rose suggested, and Melissa did too, it's wartime consigliere time. It is not just the advisor that you might have had, it's asking that advisor, could you bring in people that are used to dealing with struggling businesses or stabilizing businesses or increasing market share? Often I will sit with a client and their advisor, and the client will be asking questions, do you know anybody that does these things? And I say, well, Mary does. She's been with you for years. And he looks over and says, Mary, I didn't know you knew anybody that did that. And Mary looks over like, I've been telling you for years. So your clients may not have heard you. Clients or business owners, you may not have heard your advisor. Choose the person you trust the most. Reach to them and say, who else should we be bringing on to talk to right now? Yeah. Just like Rose said. So questions out there we've been answering from the chat room as it's been going. I don't see any others that are in there. Melissa, did you have any questions or thoughts before we head off?
No, I tried to respond to the questions that I saw in there. I didn't respond to every one of them, but if anybody has any questions, I'm happy to respond. We can have a conversation, or if you want to send me an email, and I'm happy to answer any questions. And I just want to make sure, you know, there is negative stuff out there, but there's a lot of positive factors out there too. So values are not down, you know, they're not at zero. Companies have values, and they're, you know, they're just lower than what they were. And so I want to make sure that everybody gets that message.
So by all means, if you got questions about the presentation, all of our presenters, every time we present, are open to helping advisors or clients think through some things, not for looking for business, but be able to help or give resources to others. You can see Rose's contact information here as an M&A attorney and general business advice. Great at what she does. And as you've seen on this call, not only an approachable and very smart at what she does, a delight to work with. And both ladies are very apt to partner up with other advisors in getting a second look at things, because both have a long-term view of their practice. The favors they do now will be the people that communicate with them next year and the year after. So ladies, thank you so much for today. We really appreciate it. Rose, thank you.
Thank you. It's been a pleasure.
And
let me
Melissa,
just
thank
say-
you as well.
Thanks, Joe. And let me just say, for everybody who's participating in this, thank you very much. We're trying to be resources to all the business owners out there, and we're trying to bring in the expertise to help guide you as we're going through this evolution of business, because we just don't know what's going to be. So this is a series that we hope we are going to continue. And we'll continue to bring in additional experts to try and have realistic conversations about what's going on and how does everybody get through this. And as Joe was saying, how do you make your next fortune through this this situation and the economic conditions that we're in right now. So thank you for attending.
Thank you all for attending. Shelley, anything more?
No, sir. I think I can stop sharing. Hopefully everybody got the information, and watch your emails for follow-up information. And by the way, I'll mention one more time, the recordings for this will be available by Monday, and you'll receive instructions on how to access that on your thank you email that you receive. So I think that's it.
All right. Thank you, everybody, very, very much. Talk to you soon. And Gina, love it when your daughter joins us.
Bye.
Bye. Thank you.
Bye, everybody.